Let's start with the number that matters. On Friday, the 14th of August 2026, gold registered a solid gain of nearly 0.9% while the US dollar weakened across the board. That single session capped a week in which softer American inflation data forced traders to rethink the Federal Reserve's next move. In fact, by Tuesday the 11th of August, gold had already firmed above $1,820 an ounce and scaled fresh 2-month highs. So the question on every trader's mind right now is simple. Is this a short-term bounce, or the beginning of a more serious repricing? What makes this rally interesting is that it is not driven by panic buying. It is driven by a calculated shift in interest rate expectations. When weak data hits the dollar, gold often becomes the first place money flows. That is exactly what we are seeing as we begin Saturday, the 15th of August 2026. What changed this week? The catalyst came from two fronts. First, earlier in the week, US inflation data came in softer than markets had expected. That single data point chipped away at the argument that the Federal Reserve needs to keep hiking rates. Second, the July jobs report, released on the 7th of August, missed expectations badly. That miss was a genuine shock. The research shows weak US jobs data is now fueling bets on a Federal Reserve rate cut next month, not just a pause. Think about what that shift means. A week ago many desks were still asking how high rates could go. Now the conversation has flipped to when the Fed might start cutting. That is a huge swing in the market's central scenario. Gold thrives in that environment because it does not pay interest. When rate expectations fall, holding gold becomes less expensive relative to cash or bonds. Put simply, weaker data equals lower expected rates, and lower expected rates equal a stronger bid for gold. Gold is priced in US dollars, so there is a mechanical link between the two. When the dollar weakens, gold becomes cheaper for buyers using euros, pounds, or yen, and that attracts fresh demand. On Friday, the dollar index slipped broadly, and gold's near 0.9% gain was a direct mirror of that move. But this is not just a currency story. There is also an inflation signal at work. If you read the tape carefully, gold firmed up above $1,820 an ounce earlier in the week, even as some headlines noted oil prices pushing the dollar higher. That suggests investors are looking through short-term noise and positioning for a longer period of softer US data. In plain terms, the dollar is the transmission mechanism. Weak data lowers rate expectations, the dollar falls, and gold rises. That relationship has been consistent over the past 7 days. Here is the core logic every viewer should understand. Gold pays no interest or dividend. So if you can earn a 5% yield on a US Treasury bond, gold looks expensive. But if the market starts pricing in rate cuts, those yields fall, and suddenly gold's zero yield is less of a disadvantage. This week, the shift in Federal Reserve expectations was sharp. After weak jobs data, traders moved from expecting another hike to seriously discussing a cut in September. That repricing hit the dollar and bond yields at the same time. It also boosted equities. The research shows stocks rallied on weak jobs data because cheaper money prospects tend to lift risk assets. Gold sits at the intersection of both those trades. It benefits from a weaker dollar, and it benefits from lower real yields. The near 1% Friday rally is not just speculative froth. It is the market adjusting to a new reality where US rates may have already peaked. There is a complication in this rally, and it comes from oil. The research highlights a contrasting headline on Friday morning. Gold initially retreated from its June high as oil-driven Federal Reserve rate hike bets underpinned the US dollar. Oil prices have been gaining partly because of geopolitical risk around Iran, and higher oil can push inflation expectations up. If inflation rises, the Federal Reserve might keep rates higher for longer, which would strengthen the dollar and cap gold. So right now gold is caught between two forces. Weak US labor and inflation data are pulling it higher, while oil-driven price pressures are pulling in the opposite direction. That tension explains why gold's rally has been strong but not completely one way. The key takeaway is this. As long as the weak domestic data dominates the narrative, gold has the advantage. But any escalation in oil prices could quickly reintroduce dollar strength and slow the advance. Now, why does the $1,820 level matter? Because it marks a 2-month high. 2 months ago the market was much more worried about stubborn inflation and a hawkish Federal Reserve. The fact that gold has climbed back above this zone tells you the narrative has changed. It is not just about the weekly gain. It is about the recovery from a period when higher rate expectations were keeping a lid on gold. In technical terms, a decisive close above this 2-month high could open the door to a test of the $1,850 to $1,870 zone. But technical levels are only part of the story. The fundamental driver is still the repricing of Federal Reserve policy. If the Fed signals that rate cuts are genuinely on the table, that 2-month high could become a launching pad rather than a ceiling. Looking ahead from Saturday the 15th of August 2026, the near-term direction depends on 2 things. First, any fresh comments from Federal Reserve officials. If they push back against rate cut pricing, the dollar could recover and gold could pull back. Second, the next round of U.S. economic data, especially inflation and jobs. The market is now highly sensitive to downside surprises, because weak data is the core reason this rally started. On the current evidence, the path of least resistance for gold is higher, but it is not a straight line. Traders should watch the 2-month high around $1,820. A decisive close above that level could open the door to stronger gains. However, if oil prices spike further and Fed officials sound hawkish, expect a period of consolidation rather than a breakout. For now, the balance of evidence still favors gold because the data has been weak and the dollar has been soft. So what should you take away from this gold rally? It is not really about gold itself. Gold is acting as a real-time barometer of U.S. interest rate expectations. When weak data dents Federal Reserve hike bets, the dollar falls and gold rises. That is the simple chain. But the underlying message is more important. The market has rapidly shifted from worrying about inflation to worrying about growth. That shift has consequences for your savings, your currency exposure, and your portfolio. Gold's move above $1,820 is a warning that the Federal Reserve may be closer to cutting rates than many thought even a week ago. If that repricing continues, gold could remain a core hedge in a slower growth environment. As always, do not chase a one-day move blindly. Watch the data, watch the dollar, and watch what Federal Reserve officials say next. That is where the next signal will come from. Thanks for watching, and I will see you in the next update.